South Africa's Reserve Bank earlier holding the interest rates or the repo rate unchanged. It was a unanimous decision to keep the repo rate at 6.5%, prime staying there at 10%. Let's take a look and hear what the SARB governor had to say following that rates announcement.
In the absence of shocks, relative exchange rate stability is expected to continue. Some upside risks to the inflation outlook remain, in particular from fuel, electricity, and water prices. The MPC welcomes the sustained moderation in inflation outcomes and the fall in inflation expectations of about 1% since 2016. The committee would like to see inflation expectations also anchored closer to the midpoint of the inflation target range on a sustained basis. Against this backdrop, the MPC unanimously decided to keep the repurchase rate unchanged at 6.5% per annum. Monetary policy actions will continue to focus on anchoring inflation expectations near the midpoint of the inflation target range in the interest of balanced and sustainable growth. In this persistently uncertain environment, future policy decisions will continue to be highly data dependent, sensitive to the assessment of the balance of risks to the outlook, and will seek to look through temporary price shocks. The implied path of policy rates over the forecast period, generated by the quarterly projection model, indicated no changes to the repo rate. This remains a broad policy guideline which could change in either direction from meeting to meeting in response to new developments and changing data and risks.
Well, that was the outcome of the MPC meeting with the South African Reserve Bank Governor, Lesetja Kganyago. Joining me to discuss this further is Annabel Bishop, Chief Economist at Investec, and Jason Welz, an economist at Afriforesight. Jason, Annabel, thanks so much for joining us in studio. Annabel, let me begin with you. The rates decision was expected, but was it the right call to make in this environment?
I think that's a very difficult question. Last night we saw the United States cut by 25 basis points. I think everyone in South Africa feels we want that too. So we are sitting in an environment also where inflation has come down materially, obviously coming out now between 4 and 4.5%, both in the last few months, also likely for the rest of this year. And indeed, even in the SARB's inflation targeting period, which is essentially mainly 2021. Now, again, looking at inflation, also, not above 5%. And I think certainly from that perspective, people are perhaps wondering if we will get another interest rate cut this year. But of course, the Reserve Bank has really been at pains to say that the result of the slowdown, or the reason for the slowdown in economic growth over the past decade has really been due to structural issues. And, if we look at South Africa's interest rates, I was just struck now at the start of the speech by the governor that we watched, that little snippet, that 6.5% is actually a very low interest rate for South Africa. Historically, it's extremely low and, quite competitive for an emerging market. And I think, from that perspective, you have a look at the advanced economies, we need to maintain a difference between our interest rate and those of advanced economies. If we cut too fast and we cut too low, then we tend to see very substantial currency weakness. So yes, the Fed has cut by 25 basis points, but it also seems from their commentary last night they were probably not looking to do more this year.
Mm-hmm. I mean, Jason, just to bring you in the conversation now, your take on what the Monetary Policy Committee decided. I mean, unlike that of the US Fed, whereby there were divergent views as to how interest rates should be dealt with, this was a unanimous decision that we keep the repo rate on hold for now.
Well, firstly, thanks for having me on. But I think definitely we should be cutting, I think. We've got scope to cut now. Globally, central banks are cutting. Even the SARB's own exchange rate forecast for next year, they see a pretty much flat rand in real terms, and actually strengthening rand. And the fact that our inflation's consistently, since November of last year, consistently been under 4.5%, I think we're at below growth potential. And in a country like ours, we really need to be pushing the limits, getting to that ceiling before inflation starts really biting, but making sure that we definitely encourage growth as much as possible in this country. And while structural factors are definitely important, monetary policy does have a role to play. Even a small uptick in growth can have major impacts on people's lives in this country. And especially considering the recent uptick in August inflation was mostly driven by food prices. And the inflation scare or the future inflation scares are mostly related now to this recent oil price shock that we've experienced. But as the SARB, I don't think you should be focused too much on these external factors, these external shocks. Focus, yes, on the second round effects on the inflation, but actually, why should you respond to an oil price shock unless inflation is completely out of control? You're just going to hold back growth, and already these high oil prices should be impacting on growth. So yeah.
For sure. I think you guys are in agreement there. I mean, there was a room to cut, but we didn't cut. Do you think that he focused on what happened recently with Saudi Arabia, Annabel?
I don't think there was undue focus on it. If anything, perhaps it's maybe the feeling that it's a blip and it might work its way out the system. Yes, I think it's a really important point that we haven't felt the impact yet, because obviously there have been oil supplies to cover the immediate impact of halving Saudi Arabia's exports. But looking forwards, I think we do anticipate seeing other oil exporters picking up and increasing their production. Of course, Russia, being one of them, and the United States are likely increasing their production quite substantially now to cover this deficit going forwards. So I think, the oil prices probably will stay elevated for a while, probably around $65 a barrel. But that's not an extremely high price. And if the exchange rate doesn't appreciate materially, if it stays where it is or even continues to tick a bit stronger as it has been doing since last month, the impact on petrol prices here should not actually be extreme.
Jason, for the longest of time, the Reserve Bank has stressed that the weakness in the economy, there's only so much that it can do without fixing the structural imbalances. What difference really is a 25 basis point a cut in interest rates going to make to the global economy? I'm just interested in your views there, especially in saying that, we did have scope to cut here because of the background that we're in right now. And if he had cut, would 25 basis points would that have been sufficient, or would he have had to, as the SARB, cut by more to really see some impact in the underlying economy?
Well, of course, they don't want to go too far too quickly. And with the rate cut last meeting, definitely there is a risk that they could go too far. But I still think that they should have cut. Sorry, Fifi, could you just repeat the rest of that question? I got a bit lost.
You're not the first economist I speak to that says that there has been scope for the Reserve Bank to cut interest rates. Just looking at the move out of the US Fed last night, had we have cut, the spread in terms of carry trade would have remained equal. My question to you was whether a 25 basis point cut would have been sufficient in this economy right now, or would the SARB have had to cut by a bigger quantum to really see growth going?
Well, see, every little bit counts. On the margin, there'll be some people who will respond to the low interest rates. Not everyone, of course, but it should definitely promote lending in the economy, promote some growth, and ease some struggling businesses' balance sheets issues where they're struggling to repay debts in this low growth environment, and especially with external demand from the broader global economy being impacted by the trade war. I think we need to stimulate internally, and if it comes at the cost of slightly elevated inflation, then that's something we've got to deal with. But if we're not overshooting the 6%, and if we're not even overshooting 4.5%, then I think we should be cutting, and I think it will make some difference. And even now we've seen the response on the exchange rate to this cut. Initially, the rand strengthened quite a bit, but within minutes it was back to where it started trading. And I think we need a weaker rand, to be honest. Our export industries are struggling with low demand. Our mining industry is struggling with above inflation increases in costs every year. And a weaker rand really helps those industries quite a bit.
We continue to review the interest rate announcement coming out of the SARB earlier today. Really find out the impact that this could have on the economy. Annabel Bishop, Chief Economist at Investec, and Jason Welz, an economist at Afriforesight, still with me in studio. Annabel, no changes made to the growth rate for this year, but the Reserve Bank is seeing a slowing in growth for the next 2 years or so. As Investec, do you hold the same house view?
I I think that's right. And indeed, the risk is for the global economy as well. And if you have a look at the Reserve Bank's QPM model, quite interestingly, its quarterly projection model, it shows no further interest rate cuts, or indeed increases, no change at all in rates going forwards. So I think, that's what the Reserve Bank is really looking at, a deteriorating growth environment this year, certainly. Next year and the following year, some pickup, but still very mild growth rates, and little to no change in interest rate really to support the economy.
Jason, I mean, in terms of economic growth, what do you make of the big threats to South Africa's growth? I mean, right now, I'm sure you'll say much of it is domestic, but we've got everything happening globally that could be quite a risk. But from your point of view, how do you see things playing out in terms of growth?
Well, I mean, for sure, the global economy is definitely slowing down. It's at some risk. Some might even calling for a recession next year, 2021. But I think the domestic factors really overshadow that in South Africa's case. We've got Eskom with a soon-to-be-announced turnaround plan, or hopefully soon to be announced. And then we've got the Moody's rate decision that's coming up around the 1st of November, hopefully. And I think that's one of the reasons that the bank didn't cut. If one of these plans goes awry, if Moody's cuts us to junk status, or if the Eskom turnaround plan is not, the markets don't like it, then we can see a material depreciation in the rand, and that would obviously boost inflation by pushing up import prices a little bit. And I think that's one of the key factors that the SARB is worried about. Last meeting, actually, they mentioned that the QPM was pointing towards a fourth quarter rate cut. So they jumped the gun a little bit, cutting early. And I like to think that they saw these political events on the horizon, and they wanted to get a rate cut in while they could before any of these risks can actually materialize. And so I think they're going to take a wait-and-see approach. But after these political events in the next few months, mid-November meeting, I definitely think they have scope to cut.
I think one of the biggest political events that we are expecting is the medium-term budget policy statement, and then shortly after that the Moody's rates announcements. I mean, we seem to have been given a free pass so far from Moody's, but do you think that we are out of the woods? And would you say that you agree with Jason in the sense that perhaps the SARB governor was waiting to hear what Moody's has to say before moving?
Look, I think certainly that did happen a year ago. There was great concern about the Moody's credit rating, and when we didn't get a downgrade, we actually saw a rate change materialize. But looking forwards now, the budget's actually being pushed potentially now to the 30th of October, and Moody's obviously having its country review on the 1st of November. So, the point is Moody's doesn't have to move at that country review. If it wanted to downgrade us, it could do it any time, and indeed even change our outlook any time. But yes, I think that certainly is a cautionary position for the Reserve Bank. And of course, they have done some work before indicating that if we do get a credit rating downgrade from Moody's, obviously being the last of the key credit rating agencies that have us on investment grade still, we could see our short-term money market rates move up very substantially, and obviously bond yields as well. This might necessitate even a 1% increase in the repo rate. So hopefully we don't get that, and hopefully we don't see such a substantial reaction either in the market should we get a credit rating downgrade. I believe we probably wouldn't, because a lot of this has already been factored in. If we have a look at the credit default swaps, we can see a lot of this has been priced in. South Africa being at sub-investment instead of investment grade rating. But I think a whole gamut of factors really influence the Reserve Bank decision today.
I mean, in the event that we don't, I do know that there is a view on the street that we most likely will get a cut in the fourth quarter of this year. Would you agree with this?
If we don't get a credit rating downgrade, and if the budget is not one which proposes further significant tax increases, or indeed any scare stories come out of the budget, and of course if we do get a good, credible turnaround plan from Eskom, and indeed repair to governance as well, likely to be significant at the other SOEs, and of course, looking at the finances in terms of the impact of the SAA on our government public purse as well. All of those factors together then would probably cause the Reserve Bank to feel a lot more comfortable. And of course, if the United States looked like it was going to cut further as well, if the global environment wasn't looking strong, I think certainly the Reserve Bank would consider another 25 basis point cut in the last quarter of this year.
And Jason, for you, in terms of local rates, where are they headed against expectations that we could well get another cut out of the US Fed, against the backdrop of more stimulus being injected there in the Eurozone and them cutting rates? Of course, the BO or the Bank of England keeping their rates unchanged, but a fourth quarter rate cut possibility for South Africa on the cards?
Well, if we take a look at the US, they've consistently said that they on some mid-cycle adjustment, they're probably not going to cut rates, but the market doesn't believe them at all. They're pricing in further rate cuts this year, even further rate cuts next year. And I think if that actually starts materializing, if the Fed does cut rates again, then definitely there should be a rate cut from the SARB. But going into next year, the SARB's own forecasts call for average repo rate of 6.4% next year. So even they're seeing further cuts.
But just finally, Jason, anything else stand out for you in the announcement made by the SARB earlier this afternoon?
Well, one thing in the post the question and answer session, they mentioned, or the governor mentioned, that they hadn't actually factored in the Saudi Arabia attack into their decision. Their oil price forecasts and inflation forecasts had been looked at last week before the bombings, and that was a shock to me. I thought that would be maybe their justification for keeping rates on hold, but with that not even factoring into their decision, it just seems like a very strange stance from them. But I guess the political events on the horizon, as I've mentioned earlier, those are probably factoring into the wait-and-see approach that they seem to be taking.
Annabel, for you?
What stood out for me was the focus in the MPC, which seemingly seems quite new, on inflation expectations needing to be anchored around 4.5%. Certainly.
What do you mean new?
Well, new in terms of it really seemed to be quite important this time around. If you have a look at past MPC speeches, MPC committee speeches, look at the statements, certainly it's an important factor, but it really seemed to come through this time that, yes, we have had a subdued inflation environment. We have seen inflation come down since 2016. We have seen inflation expectations come down from 2016, and indeed they used to be above the 6% mark, but now they particularly want them anchored at the 4.5%. That's quite a strong downward trajectory, from being above 6 to now 4.5%. That, to me, stands out, that the Reserve Bank will continue its vigilant stance on inflation, and therefore probably not likely cut that quickly or that easily at all. In fact, we may not see any interest rate cut this year or even next year, because if you really want to push inflation expectations down to 4.5%, sure, they've been falling quite significantly, and salary and wage increases also alongside them, you need to remain quite vigilant and not obviously have an easier monetary policy stance. So I think perhaps that is something quite interesting to look at. But the Reserve Bank, obviously, again, very aware of what's happening globally, very aware of what's happening domestically, and willing, to move if necessary, but still primarily focused on inflation.
Sure. And of course, that was a unanimous decision. So clearly the focus on the inflation expectation outlook and being anchored to the midpoint of the target range was something that wasn't contested by any of the other governors. But thank you so much for your time. We were unpacking the SARB's rates announcement with Annabel Bishop, Chief Economist at Investec, and also Jason Welz, economist from Afriforesight, who joined us via Skype.